Hi, I wanted to talk about market link CDs and how they work. I'm seeing a lot more interest in these. They're relatively new out there, but I think they are attractive for the right person. But I want to go through the different pros and cons and how they work and how they're different than traditional CDs. But one thing to think about, the Fed has talked about cutting rates, and as they cut rates, then money market yields will continue to drop with each rate cut, and so will the short-term CD rates. So this is a way to try to lock in some duration, capture more upside if you do think that the market or some underlying stocks could do well over the next couple of years. So first, what are they? They are certificates of deposit where the returns are linked to a stock's performance rather than linked to a set interest rate. They are FDIC insured, at least the principal is FDIC insured. And unlike a traditional CD that pays interest every month or semi-annually, this will not pay anything until the end when it fully matures. Again, fully principal protected, assuming you hold it all the way until it matures. It is subject to the credit risk of the issuer. Many of these are issued through the big banks, but that's something I can help with the due diligence on. They have market-based returns, so again, they're linked to a referenced asset's performance. So it could be S&P 500, NASDAQ, Russell 2000s, maybe some kind of international index, even gold prices. There are a bunch tied to Apple, Apple stock or Amazon, Nvidia, Tesla. Again, a lot of ways to do this. And for people that want some of the upside growth potential, but they want to protect some downside, that's where I think these could be a good fit. Like I said, the upside could be capped on many of these, and there are no dividends. So if you have a stock that pays a dividend every quarter, this is not an alternative to that. It doesn't matter what gets paid out. It's really more about the starting value on day one versus the ending value at the end of that duration. Here's a couple examples of some common market link CDs and how they would work. So this first one, figure $1,000 per unit is the issue price. This was a 20% cap. So if this underlying index goes down 20%, it doesn't matter. You have a floor here. Again, full FDIC insurance on that principal. You're going to make between 0 and 20%. If the underlying index goes up 60% or stock goes up 60, you're still capped at 20. So you'll be earned between 0 and 20%. This one's a little different. This one is uncapped. This one has a 5% max loss. So if you started with $100,000, after 3 years, whatever the duration is, you would have a worst case scenario of $95,000. So some people like that, having that floor potential, especially considering the upside is uncapped here. Again, they're all built differently. They have different benefits, pros and cons. Many have participation rates. Both those examples had 100% participation rates. Some of them have a max return or a cap. Some of them have a minimum return, max loss or a floor, total downside risk. And then the maturity term, how long is this? Is this 1 year, 2 years, 5 years? It seems like many of them are kind of 2 to 3 years seems to be the sweet spot, but I'm here to kind of help you go through the what's out there based on your situation, try to figure out what's most appropriate for you. What are the benefits? There's growth potential. So again, if CDs and money markets are looking to yield between 3 to 4%, and we think that the market or an underlying stock can outperform that over the next 2 or 3 years, then these have more upside growth potential than what a money market or CD is going to offer. Like I said, the returns may exceed traditional CDs, but they are subject to a cap in many cases. Principal protected, subject to the issuer risk or credit risk of the issuer. You could buy them inside an IRA or a Roth or a non-retirement account, just traditional brokerage accounts. Risk and considerations. Many of them are capped. Some of them have participation rates. You may not get the full upside. There are no dividends. Limited liquidity. I would only suggest doing this if you're planning to hold it for the full duration. There's a secondary market where you could sell them, but it really depends how long you've had it, whether it's above water or underwater, how the underlying stock has performed. So although you could likely liquidate it, you may be selling that at a loss. So you're better off trying to hold this until it matures. There is some issuer risk here, although FDIC insurance. Best for someone looking for principal protection and market exposure, someone okay with limited liquidity, comfortably capped returns. Not suitable for someone that needs the money in the near term, somebody that I think growth investors, people that are more okay with risk, okay holding individual stocks, okay with 20-30% up and down swings, then this is probably not appropriate for them. But for somebody that is looking to kind of put a collar on their investments, or have some kind of floor on there, then I think that's where these are most attractive. But again, if you think this is something that you want to look into, give me a call. We can talk more about some different options. You can message me. But there's a pretty vast array of options here, again, tied to stocks. Some are tied to combinations of indexes. But once you kind of explain your situation, what you're trying to do, I can kind of shop around and make some recommendations, and see if it's even appropriate. It may not be appropriate, and there may be other options for you. But anyway, appreciate you watching. Thanks for your time. Take care.